Revenue at America's largest home builder fell by less than 4%. Operating income fell almost 19%. Net income fell almost 20%. When profits drop roughly 5 times faster than the top line, the problem is not that fewer homes are being sold. It is what each one earns. This is Dr. Horton's report on the first 9 months of fiscal 2026, and it is a margin story from top to bottom. We'll go through the segments, the margin bridge, the cash flow, and the $2.2 billion of buybacks quietly holding up earnings per share. Dr. Horton is a U.S. home builder listed in New York. The figures come from its Form 10-Q, filed on the 23rd of July 2026 for the period ended the 30th of June. This is a 9-month filing, so every revenue, profit, and cash flow number here is cumulative for the first 9 months of fiscal 2026 against the same 9 months a year earlier. The balance sheet is a snapshot at the 30th of June, and where it moves against the start of the fiscal year, not against last year. The model is simple: build homes, sell homes, and finance the buyer through a mortgage arm. Start with the top line. Revenue for the 9 months was $23.67 billion, down 3.7%. That is soft, not a collapse. Then look underneath. Gross profit, $5.44 billion, down 9.6%. Operating income, $2.68 billion, down 18.6%. Net income, $2.15 billion, down 19.9%. At every step down the income statement, the decline gets bigger. That pattern has a name: operating deleverage, EPS. It happens when the price of what you sell falls faster than the cost of making it, and fixed costs don't shrink to match. Diluted earnings per share of $7.45 fell only 12.7%, and we'll come back to why that gap exists. So is the profit backed by cash? Operating cash flow was $880.8 million, down 7.2%. Against net income of $2.15 billion, cash conversion is roughly 41%. That looks weak, but for a home builder, it is largely structural. Profit is absorbed back into land and homes under construction, which sit in inventory and only turn into cash when a house closes. The important detail is direction. A year ago, that ratio was about 35%, so conversion improved because cash flow fell 7% while net income fell 20%. What the data does not split out is deliberate investment in new communities versus unsold inventory building up. That distinction matters, and it isn't verifiable here. Now, the segments and the concentration is extreme. Home building operations generated $22.24 billion of revenue, 94% of the entire company, down 2.8% year over year. Everything else combined is 6%. So the margin compression we just saw is really about one thing: the price and cost of the homes this company closed. Incentives, buyer rate buydowns, and land cost all land inside this segment's gross margin. Revenue here barely moved, which tells you volume is not the binding constraint. What each closing earns is. There is no management commentary in this data to attribute it further. The other 3 segments are small, but they say something. Financial services, the mortgage and title operation, did $598.2 million, down 4%, tracking the closing volume it serves. Rental did $587.4 million, down 29.7%, by far the sharpest decline in the group. And because rental monetizes through bulk property sales, it is inherently lumpy. But at 2.5% of revenue, it cannot explain group margin. The only segment growing is land, up 8.7% to $246.5 million, 1% of the total. So rental is the biggest decliner in percentage terms. Home building is what actually moves earnings. Side by side, the 2 reported periods point the same way. Revenue went from $24.57 billion to $23.67. Gross margin, 24.5% to 23%. Operating margin, 13.4 to 11.3. Net margin, 10.9 to 9.1. Return on equity, 10.9% to 9%. Free cash flow, $855.5 million to $774.2. Not one line moved the right way. Equity shows the same shape sequentially, $24.56 billion at the end of December, 24.2 billion at the end of March, 23.82 billion at the end of June. 3 consecutive step-downs, and as we'll see, that is not losses doing it. Here is the bridge. Revenue fell 3.7%, but cost of revenue fell only about 1.8% to $18.23 billion. Costs came down at half the rate of sales, and that alone takes gross margin from 24.5% to 23%, with gross profit down 9.6%. Next, selling and administrative expense actually rose to $2.76 billion from $2.72, up 1.4%. A flat cost base against shrinking revenue is why operating margin fell 2.1 points when gross margin fell only 1.5. Below the operating line, other income contributed $207 million, mostly interest on the cash balance, versus $237 million a year ago. And the effective tax rate rose to 24.7% from 23.5%, every step subtracted. Now the cash flow statement. Operating cash flow, $880.8 million. Capital expenditure of just $106.6 million, with depreciation of $84.8 million. This is not a capital-intensive business at the property and equipment level. The capital is tied up in land, not factories. That leaves free cash flow of $774.2 million against $855.5 million a year earlier. The investing outflow widened to $213.5 million from $123.5 million. The financing outflow was $1.57 billion, large, but smaller than the $2.7 billion a year ago. So the machine still generates cash. The question is, what happens to it? This is where that earnings per share number comes from. The company spent $2.2 billion on share repurchases and $388.3 million on dividends. Around $2.59 billion returned to shareholders against free cash flow of $774 million. Roughly 3.3 times free cash flow, and the difference comes off the balance sheet. Diluted shares fell from 314.1 million to 288.4 million, down 8.2%. That is why net income fell 19.9%, while earnings per share fell only 12.7%. Roughly 7 percentage points of the per-share result came from a smaller denominator, not better operations. It is genuine value returned to owners. It is also not repeatable indefinitely at this pace, which brings us to the balance sheet, the strong part of the report. Total assets of $36.51 billion. Chantimis, total liabilities of $12.1 billion, equity of $23.82 billion. Liabilities are about a third of assets. Debt to equity is 0.51 times, and $2.08 billion of cash covers roughly 17% of all liabilities. Retained earnings of $32.8 billion cite above total equity. The signature of years of share retirement. Equity is down 1.6% since the start of the fiscal year, and that comparison is against fiscal year-end, not last year. The decline is a choice, not distress. Distributions simply ran ahead of profit. A softening cycle is much easier to absorb from this position. 2 things on signals. First, insider activity. 0 open market purchases and 0 open market sales in this window. Not bullish, not bearish, just an empty window, worth saying, because an absence of selling is sometimes misread as conviction. Second, corporate events. 1 filing of substance, an 8K on the 21st of July reporting quarterly results and declaring the quarterly dividend. Routine. No acquisitions, no leadership change, no capital structure action. There is also no earnings call transcript in this data, which means backlog, net orders, cancellation rates, and management guidance are not reflected in anything I've said. For a home builder, those are exactly the forward-looking numbers you'd want. So treat this as a picture of the reported past. 4 things to watch in the next filing. 1. Gross margin. 23% is the anchor. Whether it stabilizes there or keeps eroding is the single biggest driver of earnings, far more than volume. 2. Selling and administrative expense in absolute dollars. It rose to $2.76 billion on lower revenue. If it stays flat while revenue falls again, the deleverage continues. If it comes down, management is acting. 3. Buyback pace against cash flow. $2.2 billion of repurchases against $881 million of operating cash flow is funded partly from the balance sheet, so watch the cash balance. 4. The rental segment after a 29.7% decline. Stabilization or continued wind down. So the one-line version. D.R. Horton is a well-capitalized business absorbing a margin-led earnings contraction, with the per-share line cushioned by buybacks running ahead of free cash flow. The accounting looks clean. No one-offs, no acquisition distortion, and the below-the-line contribution is ordinary interest income. What is deteriorating is earnings power, and it is deteriorating through gross margin rather than demand. Revenue down, under 4%, net income down 20%. Next quarter, the question is not whether volumes hold. It is whether 23% gross margin holds. Thanks for watching. This is my stock analysis.